In today's video, we are reacting to a fresh Dan Ives interview on CNBC's Power Lunch, where he says something that should have every investor paying attention. Dan Ives believes that 2026 is going to be the year cybersecurity meets AI, and that cybersecurity could become the next frontier for AI investing as we head into the new year. I am going to show you the clip first, so you can hear exactly what he said, and right after that, I will break it all down with my own reaction, and explain what it means for the AI trade, and where the real opportunities may be setting up. Then after that, I am going to give you an in-depth analysis of my top 3 growth stocks to buy right now. If you only watch one video today, make sure you watch this one all the way to the end. Hit the like button, let's get 1,000 likes on this one, share the video, and drop your thoughts in the comments. Subscribe to the channel so you do not miss the next important financial investing update. Now let's hear what Dan Ives has to say.
Give me, on a 0 to 10, your excitement level about Nvidia, Tesla, and then cybersecurity in kind of ranked order. Or is it just going to be an, rising tide lifts all boats next year? Why does CrowdStrike in particular jump out to you?
Yeah, well, Cal, to me, it's really about this is going to be the year for cybersecurity meets AI, because as all these workloads are moving to the cloud, the use cases are building, the Palantirs, the Mongos, the Snowflakes. Cybersecurity is going to be front and center. Now, of course, it all starts with big tech in terms of Nvidia, Microsoft, the hyperscalers. But when I look at CrowdStrike, and I think what Kurtz and the team are doing, they're at the intersection. And I think they probably have some of the best AI footprint when it comes to cybersecurity. Investors way under the radar in terms of this name.
Yeah, I've heard a few others talking about this, and in general, that dealing with AI is moving into the security space, into the software management space. Is that kind of how you see it?
Yeah, look, we've talked about Palo Alto. You look obviously at CrowdStrike, Zscaler. But I think the reality is that it's all about second, third, fourth derivatives. And we talk about that in Ives AI 30. And you look where cybersecurity fits front and center in terms of where we see that playing, in terms of where CrowdStrike is. And I think, look, this is really going to be about the derivatives playing out across the space. We see it on authentication, with where we are on orbs. But I think cybersecurity, it's going to be a golden year for cybersecurity.
The stock CrowdStrike is up 40% this year. That's already pricing in a lot. That's a really nice run. That probably outperforms a lot of the Mag 7. It probably rivals Nvidia.
I'd say get the popcorn out, because I think this is a stock that could have, ultimately a 6 in front of it. And when I think about, 700 bull case, because right now we're talking about trillions that are going to be spent. We're still in the early innings from the use case perspective. When you look where CrowdStrike plays cybersecurity, I think also you're going to see a lot of consolidation in the space. I think this, as a subsector, cybersecurity could be one of the best performing of all of tech because of this AI trade.
And can you, Dan, just explain as a non-specialist to me, are you saying that these are companies that because of AI, they need to defend themselves against different types of threats? Are they securing kind of entry points throughout the data stack and that sort of thing? Just how do they fit into kind of the compute behind AI?
Yeah, if you think about it, okay, so you have the Nvidia chips, you have the hyperscaler build out, you go on a use case, an enterprise. How do you protect the work? How do you know the users internally, externally? That's all in the cloud. That's a whole nother use case in terms of agents, in terms of threats. That's where CrowdStrike's going after. That's why it's really the intersection of AI and cybersecurity. And as you see more companies go down that path, cybersecurity, which I'd say to some extent has really been viewed in the background, it's going to be front and center. You're not going to be able to do it without cyber. And that's where names like CrowdStrike, Palo Alto, Zscaler, names like Checkpoint, I think play out. And I think it's very important in terms of this theme in 26.
Yeah, and so can I pivot and ask you about the news of the day also, Dan, this Nvidia deal, this licensing agreement with Grok, G-R-O-Q, for their language processing units. They say this could require less compute, be more efficient, maybe fend off or answer a little bit of what Google's doing with its TPUs. Maybe raises some regulatory concerns, although, again, they seem to be doing so in a way that would perhaps dodge all of that. What's your interpretation of the deal?
I think it's a massive poker move by Jensen, because you look what's happening with Google on the TPU side, on the inference, and this is really Nvidia. Look, this is them flexing their muscles, because they're going further and further expanding out, making sure competitively but also on the offensive, because you go in 2026, this is going to be a huge pain point. It's one of the best technologies out there. And I think, look, this just speaks to what we're going to see. More and more consolidation, more and more acquisitions, more and more deals that we see in this arms race that's going on. And look, the godfather of AI, Jensen, is not just going to sit there, watch us from the stands. It's going to be on the field, and this is a smart move at the right time.
The host opens by framing something most investors overlook. We talk nonstop about the AI trade, hyperscalers, data centers, and the infrastructure build-out. But there is a critical layer in the middle of that stack that becomes more important as AI adoption scales, and that layer is cybersecurity. That is the setup. Dan is being brought in because he published a new note calling out what he thinks is the best way to play what he calls the cyber AI theme. Then the host asks a question that is basically designed to force a ranking. On a scale of 0 to 10, how excited are you about Nvidia, Tesla, and cybersecurity, and is it just going to be a rising tide lifting all boats next year? And why does CrowdStrike jump out in particular? Dan's answer is telling, because he does not actually treat this like a simple ranking exercise. He zooms out and says, this is the year cybersecurity meets AI. That phrase matters. He is saying cybersecurity stops being a background line item and becomes a front and center strategic priority because the workloads are moving to the cloud and because the number of AI use cases is expanding quickly. When he mentions workloads moving to the cloud, think about what that implies. As companies adopt AI, they are not just buying a few software subscriptions. They are reorganizing how data flows through the business. They are connecting models to internal documents, customer data, employee workflows, and third-party applications. That creates more entry points, more permissions, more identities, more endpoints, and more things that can go wrong. AI does not just add opportunity. It adds attack surface. And Dan makes an important point that people miss when they only focus on Nvidia and the hyperscalers. Yes, in his mind it all starts with big tech. Nvidia, Microsoft, and the hyperscalers are the foundation. But once the foundation is being built, the rest of the tech stack has to scale with it. The moment enterprises start deploying AI broadly, cybersecurity becomes unavoidable, not optional, not a nice-to-have. Unavoidable. That is why he calls out CrowdStrike so aggressively. He references George Kurtz and the team, and he says CrowdStrike has one of the best AI footprints in cybersecurity, and that investors are underestimating it. Basically, that it's underappreciated relative to how central it can become in this new cycle. Now, I want to translate what he is implying in plain language. He is saying AI creates new kinds of threats and also increases the speed and sophistication of old threats. Attackers can use AI to write better phishing, automate reconnaissance, and scale attacks faster. Meanwhile, defenders need AI to detect anomalies faster, correlate signals across endpoints, and respond in real time. In other words, the offense gets smarter, so the defense has to get smarter too. That is the arms race inside the arms race. The host then adds another angle, saying people are talking about AI moving into security and software management. Dan agrees and expands it by using the concept of second, third, and fourth derivatives. This is classic Dan Ives framing. He loves the idea that the first order winners are obvious, and then the market broadens into the picks and shovels behind the first order winners, and then it broadens again into the next layer. So what are the first order winners? Nvidia, the hyperscalers, and the biggest platforms. Second order winners are often the software layers that help companies deploy and scale AI. Third and fourth derivatives are the categories that become mission critical because AI is everywhere, like identity, authentication, network security, endpoint protection, and cloud security posture. When he mentions names like Palo Alto Networks, CrowdStrike, and Zscaler, he is basically mapping out the main public market leaders in different parts of that security stack. CrowdStrike is known primarily for endpoint security and threat intelligence. Zscaler is often associated with secure access and zero-trust network access, protecting users as they connect to cloud apps. Palo Alto spans network security and has expanded aggressively into cloud security and platform consolidation. The common thread is not that they are random cybersecurity companies. The common thread is that they sit directly in the path of enterprise cloud usage, which is exactly where AI workloads are increasingly living. Then, he calls it a golden year for cybersecurity. That is a strong claim, and the host pushes back with the obvious objection. CrowdStrike is already up 40% this year. Isn't that already pricing in a lot? It is a fair question, and it is also the kind of question retail investors ask right before a trend accelerates again because they focus on the past move instead of the future market expansion. Dan's response is pure hype, but it is also strategic framing. He says, get the popcorn out, and then he implies he could see the stock with a 6 in front of it, and he references a 700 bull case. That is him saying he believes there is more upside even after a big run. He justifies that by going back to the core macro driver. Trillions are going to be spent, and we are still in the early innings from the use case perspective. Here is the important part to understand. When he says trillions, he is talking about the combined spend across data center buildouts, GPUs, networking, storage, cloud services, and the broader AI enterprise adoption cycle. If that level of spend is real, then cybersecurity does not just grow in a straight line. It grows as a function of complexity. The more mission-critical the systems become, the more companies are forced to budget for protecting them. And he adds another key point: consolidation. He expects consolidation in the cybersecurity space. This is not just a throwaway line, it is a realistic outcome when a category becomes strategic and budgets shift toward platform solutions. Large players often try to bundle, acquire, and build end-to-end security platforms so enterprises can reduce tool sprawl. If consolidation accelerates, that can create two things at once. It can create premium valuations for the perceived category leaders, and it can also create M&A optionality for smaller players, which makes the whole group feel like it has a tailwind. Then the host asks him to explain it to a non-specialist. This is where Dan lays out the stack in a very simple sequence: Nvidia chips, hyperscaler build-out, then enterprise use cases. And as soon as you go to use cases, the question becomes, how do you protect it? How do you know who the users are internally and externally? How do you handle agents and threats? He says that is where CrowdStrike is going after. The word agents is important, even though he does not fully unpack it. In the AI context, agentic workflows can mean systems that take actions on behalf of users, interact with tools, access data, and trigger processes. That is powerful, but it is also dangerous if identities, permissions, and device security are not tightly controlled. If a compromised identity or endpoint can trigger agent actions, the blast radius can expand quickly. So the security layer is not just protecting laptops, it is protecting access to AI-enabled workflows that can touch real business operations. Dan then says something that is the core investment thesis in one sentence: you are not going to be able to do it without cyber. That is the punchline. AI adoption without cybersecurity becomes operationally reckless. Boards, regulators, and customers will not tolerate it. Enterprises can delay some upgrades, but they cannot ignore security once the core workflows move into the cloud and AI systems touch sensitive data. He also lists other names like Checkpoint, which signals he is not saying only one company wins. He is saying the whole group benefits, but he is highlighting his favorite for this specific intersection. And he ties it to 2026, implying he expects this theme to intensify as we move deeper into the adoption curve. Then the interview pivots to Nvidia news of the day. The host brings up a licensing agreement with what they pronounce like Grok, but what this sounds like is Grok, the company known for language processing units focused on inference efficiency. The host frames it as potentially requiring less compute, being more efficient, and possibly responding to what Google is doing with TPUs. They also mention potential regulatory concerns, and the idea that Nvidia may be structuring it in a way that dodges issues. Dan calls it a master poker move by Jensen Huang. That language is intentional. He is framing Nvidia not as a company that is passively benefiting from demand, but as a company actively shaping the battlefield. He says Nvidia is flexing its muscles and expanding further and further, staying competitive, but also going on offense, because in 2026, this becomes a huge pain point. Here is how I interpret that. The biggest looming issue in AI is not just training, it is inference at scale. Training gets headlines because of giant clusters and giant CapEx announcements, but inference is where AI becomes a product and a daily workflow. It is where the volume of usage explodes, and inference efficiency matters because it determines cost per query, latency, and scalability. If competitors can deliver inference cheaper or faster with custom silicon like TPUs, that is a strategic threat to Nvidia's dominance. So if Nvidia is doing licensing deals or strategic partnerships around more efficient compute paths, that is Nvidia trying to keep control of the ecosystem. It is Nvidia saying, even if the world shifts towards specialized inference hardware, we want to be part of that shift, and we want to keep the competitive moat wide. Dan is basically applauding Nvidia for not letting competitors define the next phase of the AI stack. He also says this speaks to what we are going to see more and more: consolidation, acquisitions, and deals in this arms race. That fits perfectly with his earlier consolidation point in cybersecurity. His worldview is that AI is causing a broad tech arms race, and when there is an arms race, companies do not just compete with product releases, they compete with partnerships, vertical integration, and ecosystem control. So when you put the whole interview together, the message is not just buy cybersecurity because it is hot. The message is that the AI trade is maturing into a full-stack story. The market started with the obvious hardware winner narrative. Now it is moving into the infrastructure narrative. Now it is moving into the enterprise use case narrative. And as it does that, the categories that become essential for operating AI at scale will re-rate and potentially outperform. Cybersecurity in Dan's framing is not a side bet. It is a required layer for the AI economy. That is why he is so confident. Because if his premise is correct, then security spending becomes structurally supported by the same forces driving AI spending. And that is the kind of setup where even after a stock is up 40%, the debate is not about whether it is expensive relative to last year. The debate is about whether the total addressable market just expanded again. My own takeaway is this. If you believe AI adoption continues to accelerate, then you have to also believe that security becomes more strategic, more integrated, and more central to every enterprise AI rollout. You can debate which company wins the most, but it becomes harder to debate the direction. AI expands the surface area of risk. AI increases automation on both sides, attacker and defender. AI pushes workloads deeper into the cloud and into identity-driven access. That naturally pulls cybersecurity into the spotlight. And on the Nvidia side, Dan is emphasizing that dominance in AI is not guaranteed just because you are the current leader. It has to be defended. It has to be extended. It has to be reinforced through deals, ecosystem moves, and positioning for inference. That is why he calls it a poker move. He is saying Jensen is not just playing the hand he has, he is controlling the table. So if you are watching this interview and wondering what the transcript is really about, it is about the next chapter of the AI trade. It is about moving beyond the obvious names and seeing where the unavoidable demand is going to show up next. In Dan's view, cybersecurity is one of the clearest unavoidable demand zones, and the big platform leaders in AI, like Nvidia, are still making aggressive moves to keep their moat intact as the battlefield shifts toward efficiency, inference, and ecosystem control. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today, and take control of your financial future. Now let's dive into the top 3 growth stocks to buy now. First up, Eli Lilly, ticker LLY, a true behemoth in pharmaceuticals. Founded over 145 years ago, this company has evolved from a small family-run business into one of the most influential players in global healthcare. Today, Eli Lilly stands at the forefront of medical innovation, shaping the future of how we treat some of the world's most challenging diseases. Their stock has soared in recent years, reflecting investor confidence and the company's relentless drive for growth. The main catalysts? 2 blockbuster drugs, Mounjaro and Zepbound, that have taken the market by storm and redefined what's possible in modern medicine. Originally developed to treat type 2 diabetes, these drugs have quickly become the gold standard for weight loss, opening up a market worth hundreds of billions of dollars. The demand is so intense that pharmacies have struggled to keep up, and patients around the world are clamoring for access. But Eli Lilly isn't a one-hit wonder. Their drug pipeline is one of the deepest and most diverse in the entire industry, targeting a wide range of conditions, from cancer and autoimmune diseases to Alzheimer's and rare genetic disorders. This robust pipeline ensures that the company is always on the cutting edge, ready to deliver the next breakthrough. They're investing billions in research and development every year, fueling a culture of relentless innovation. Their teams of scientists and researchers are constantly pushing boundaries, aiming for therapies that not only treat symptoms, but actually change the course of disease. This commitment to R&D is what sets Eli Lilly apart from many of its peers. The sales numbers for Mounjaro and Zepbound are already staggering, with billions in revenue pouring in each quarter. And this is just the beginning. Global demand is accelerating as more countries approve these drugs, and as awareness grows among both doctors and patients. This tidal wave of revenue doesn't just pad the bottom line, it creates a powerful growth flywheel. The cash-generated funds even more innovation, strategic acquisitions, and generous returns to shareholders. It's a virtuous cycle that keeps Eli Lilly ahead of the competition and constantly expanding its reach. Some investors worry about the high valuation, and it's true. Eli Lilly trades at a premium. But with explosive earnings growth on the horizon, many analysts believe that premium is more than justified. The company's ability to consistently deliver results makes it a favorite among institutional investors. Management is scaling up manufacturing at an unprecedented pace to meet surging demand. They're building new facilities, streamlining supply chains, and proving they can execute at a global scale. No small feat in the complex world of pharmaceuticals. Beyond weight loss, Eli Lilly's portfolio includes life-changing drugs for diabetes and Alzheimer's, providing both diversification and stability. These therapies address chronic conditions that affect millions, ensuring steady demand regardless of economic cycles. This isn't just a short-term story. Demographic trends, like aging populations and the rising prevalence of chronic diseases, are powerful, long-term tailwinds. As the global population grows older, the need for innovative treatments will only intensify, putting Eli Lilly in a prime position for decades to come. Financially, Eli Lilly is firing on all cylinders. The company's delivering accelerating revenue growth, expanding profit margins, and generating massive free cash flow. This financial strength gives them the flexibility to invest aggressively in future opportunities. While competitors like Novo Nordisk and Pfizer are formidable, the market for these therapies is enormous. Eli Lilly's products are widely regarded as best in class, and their first-mover advantage gives them a significant edge. Their brand is quickly becoming a household name, trusted by doctors, pharmacists, and patients alike. This trust is invaluable in healthcare, where reputation can make or break a product's success. The company's diversified pipeline and strong execution make it a cornerstone growth holding for any long-term investor. With multiple shots on goal, Eli Lilly is well positioned to weather industry shifts and regulatory changes. Of course, there are risks. Regulatory setbacks, pricing pressures, or new competition could impact growth, but the company's track record of navigating challenges and its robust risk management make the risk-reward profile especially compelling. For me, Eli Lilly is a long-term compounder, a leader in a defensive sector that's delivering non-defensive, high-octane growth. It's rare to find a company that combines stability with such explosive potential. It's this rare combination of innovation, scale, and financial strength that puts Eli Lilly at the very top of my list of growth stocks to buy now. Innovation, massive market opportunity, and flawless execution. Eli Lilly is truly reshaping the future of medicine. Their breakthroughs are not just changing lives, but also setting new standards for the entire industry. If you're looking for a stock to buy and hold for the next decade, this is one to watch. Eli Lilly's story is about more than just numbers. It's about transforming healthcare for generations to come. The story here is about sustainable, profitable growth that's built on real innovation and real-world impact. That's why Eli Lilly is my first pick. It's a company that's not just keeping up with the future, it's helping to create it. Let's move to our next powerhouse and see where the next big opportunity lies. Next up, we head to Latin America, where another exciting growth story is unfolding. Meet MercadoLibre, ticker MELI, the Amazon, PayPal, and UPS of Latin America, all in one. MercadoLibre isn't just a company, it's a digital ecosystem that's transforming how an entire continent shops, pays, and does business. With over 650 million people and a booming middle class, Latin America is a goldmine for digital commerce, and MELI dominates the space. The region's young, tech-savvy population is rapidly moving online, leapfrogging traditional retail and banking models. Their e-commerce marketplace is the go-to destination in Brazil, Mexico, and Argentina, powered by their own logistics network, Mercado Envios. This network spans thousands of cities and towns, reaching customers in both bustling metropolises and remote rural areas. This logistics edge means faster, more reliable shipping, something competitors struggle to match. Mercado Envios handles millions of packages every day, ensuring that buyers and sellers can trust the platform for timely deliveries. But the real game changer is Mercado Pago, their fintech arm. In a region where many people have never had a bank account, Mercado Pago is opening doors to the digital economy. What started as a payment solution is now a digital wallet and financial services platform used by tens of millions, both on and off the marketplace. Users can pay bills, transfer money, invest, and even access credit, all from their phones. MercadoLibre is banking the unbanked, bringing millions into the digital economy for the first time. For many, Mercado Pago is their first experience with digital finance, giving them tools to save, borrow, and participate in the modern economy. Their fintech growth is explosive, with payment volume skyrocketing and off-platform transactions surging. In fact, more than half of Mercado Pago's payment volume now happens outside the core marketplace, showing just how deeply embedded it's become in daily life. The synergy between e-commerce and fintech is powerful. Data from the marketplace fuels smarter lending, helping sellers grow and driving more transactions. MercadoLibre can offer working capital loans to small businesses, using real-time sales data to assess risk and support entrepreneurs. Once users are in the MELI ecosystem, switching costs are high, deepening loyalty and stickiness. The more services a user adopts, the harder it is to leave, creating a virtuous cycle of engagement and growth. E-commerce penetration in Latin America is still low, so the runway for growth is massive. In many countries, online sales are less than 10% of total retail, compared to over 20% in the US and China. The opportunity is just beginning. MercadoLibre is literally building the region's digital infrastructure. From cloud computing to last-mile delivery, they're investing in the backbone that will power Latin America's digital future. Financially, they're posting 40–50% revenue growth and are now solidly profitable. Their scale and efficiency are driving operating leverage, turning top-line growth into real earnings. Founder-led management reinvests for long-term dominance, constantly innovating and expanding. 𝗗𝗏𝗧 and his team have a track record of bold bets and relentless execution, keeping Meli ahead of the curve. They're adding high-margin revenue streams like advertising, just like Amazon did. As more brands compete for attention on the platform, digital ads are becoming a major profit driver. Yes, there are risks, currency swings, political instability, but Meli's 2-decade track record and regional diversification help manage them. The company operates in 18 countries, spreading risk and capturing growth wherever it emerges. The valuation is high, but you're paying for elite growth and market leadership. Meli trades at a premium for a reason. It's the undisputed leader in a market with decades of expansion ahead. Meli is the best way to invest in the rise of the Latin American consumer. As incomes rise and digital adoption accelerates, MercadoLibre stands to benefit at every step. Their network effects, more buyers attract more sellers and vice versa, are nearly impossible to disrupt. Every new user makes the platform more valuable, creating a moat that gets deeper over time. The dual engines of commerce and fintech, plus a visionary team, make this a top-tier growth stock. Meli is not just keeping up with global tech giants, it's setting the pace for innovation in emerging markets. I believe MercadoLibre could be many times larger in a decade. As the digital transformation of Latin America accelerates, Meli's platform is positioned to capture an outsized share of the value created. This is how you build real, long-term wealth. By owning a piece of the infrastructure that powers a continent's economic future, you're investing in growth that compounds for years to come. Now let's turn to a tech titan you use every day. The next company is woven into the fabric of the internet itself, touching billions of lives around the world. Our final pick is a global powerhouse. Let's talk about Alphabet. Our third pick is Alphabet, ticker GOOGL, the digital backbone of the modern world. This is a company that's not just a household name, but a force that shapes how we live, work, and connect every single day. From the moment you wake up and check your phone, to the last video you watch before bed, Alphabet's products are there, quietly powering your digital life. You know Google Search and YouTube, they're digital utilities, woven into daily life, and absolute cash machines. Billions of people rely on them for information, entertainment, and connection. These platforms aren't just popular, they're essential, and their reach is truly global, spanning every continent and nearly every country. Their ad business is one of the most profitable ever, funding massive investments in future tech. Every search, every video, every click generates data and revenue, creating a self-reinforcing cycle of growth and innovation. This advertising engine is the envy of the tech world, and it's what allows Alphabet to take bold bets on the future. Alphabet's free cash flow, tens of billions per quarter, lets them innovate without debt or dilution. This financial strength means they can outspend competitors, attract the best talent, and weather any economic storm. It's a war chest that gives them the freedom to experiment, fail, and ultimately succeed where others can't. The real growth story? Artificial intelligence. AI isn't just a buzzword for Alphabet, it's the core of their next chapter. They're embedding AI into everything, from search to productivity tools, and even healthcare. This is a company that's not just following the AI trend, they're leading it. Alphabet's DeepMind has been pioneering AI for years, and now their Gemini model is being integrated across all products. Gemini represents a leap forward in generative AI, powering smarter assistants, more intuitive search, and even breakthroughs in science and medicine. The scale and ambition here are unmatched. AI is making search smarter, YouTube more relevant, and Google Cloud more powerful. Imagine a world where your search results anticipate your needs, your video recommendations are spot on, and businesses can harness AI to solve their toughest challenges. That's the future Alphabet is building, and it's already starting to show up in their products. Google Cloud is growing fast, now profitable, and competing head-to-head with AWS and Azure in a multi-trillion-dollar market. Enterprises are increasingly turning to Google for its AI-driven cloud solutions, security, and open-source leadership. This isn't just a side business, it's a major growth engine that's still in the early innings. Their advanced AI tools give Google Cloud a unique edge, helping win big, enterprise contracts. Companies want the smartest, most secure, and most innovative cloud, and Alphabet is delivering. This competitive advantage is translating into real wins, with more Fortune 500 companies choosing Google Cloud every quarter. YouTube is the world's largest streaming platform, monetized through ads, subscriptions, and YouTube TV, with huge growth ahead as TV ad dollars shift online. The platform is evolving beyond cat videos and vlogs. It's now a destination for news, sports, education, and live events. As traditional TV fades, YouTube is capturing the next generation of viewers and advertisers. Then there's Waymo, their self-driving car division, a moonshot with massive potential. While still early, Waymo is already operating autonomous vehicles in select cities, and the technology is improving rapidly. If self-driving cars become mainstream, Alphabet could own a piece of the future of transportation. Alphabet's portfolio offers multiple growth engines, stable ads, high-growth cloud, dominant streaming, and high-upside bets. This diversification means the company isn't reliant on any single trend or product. Instead, it's positioned to benefit from the biggest shifts in technology and consumer behavior. Despite this, Alphabet trades at a discount to peers like Microsoft and Amazon, making it a value in big tech. Investors often overlook just how much innovation and growth is packed into this company, and that creates an opportunity for those willing to look beyond the headlines. They're now more shareholder-friendly, buying back stock and paying their first-ever dividend. This shift signals a new era for Alphabet, one where they reward investors directly while still investing aggressively in the future. The combination of growth, profitability, and shareholder returns is rare. Few companies can match Alphabet's ability to grow at scale, generate massive profits, and return capital to shareholders, all at the same time. Regulatory risk exists, but Alphabet's scale and resources make it resilient. The company faces scrutiny from governments around the world, but its deep pockets and legal expertise help it navigate these challenges. In fact, regulation often raises the barriers to entry, making it even harder for new competitors to emerge. Their fortress balance sheet, over $100 billion in cash, gives them flexibility to invest, acquire, or weather downturns. This financial cushion is a strategic asset, allowing Alphabet to seize opportunities and protect itself in uncertain times. If you want exposure to the biggest tech trends, digital ads, cloud, streaming, AI, Alphabet is a near-perfect choice. It's a one-stop shop for the future of technology, with leadership positions in every major growth area. It's a growth stock with value elements and multiple ways to win, whether you're looking for innovation, stability, or long-term upside. Alphabet checks all the boxes. The core ad business funds innovation, while cloud and YouTube drive near-term growth, and moonshots like Waymo offer lottery ticket upside. This unique structure means Alphabet can take risks others can't, while still delivering consistent results. For long-term investors, Alphabet is a beautifully constructed portfolio under one roof. It's like owning a basket of the world's best tech businesses, all managed by some of the brightest minds in the industry. That's why it's my third pick for the next wave of millionaire-making stocks. The potential here is enormous, and the company's track record speaks for itself. Let's wrap up with your next move. If you're looking to build wealth for the future, Alphabet deserves a spot on your watch list, or even in your portfolio. Here's how to take action. Final thoughts coming up, so stay tuned for the steps you can take to make the most of this tech titan's next chapter. There you have it, 3 powerhouse companies leading their industries and poised for long-term growth. Eli Lilly is revolutionizing healthcare, MercadoLibre is building Latin America's digital backbone, and Alphabet is quietly dominating tech and AI. These aren't speculative plays. They're established leaders with massive runways ahead. Want more exclusive stock tips and in-depth analysis? Join the StocksGalore Patreon, link in the description. Now, which of these 3 stocks do you think has the most upside over the next 5 years? Drop your thoughts in the comments. I read everyone. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one.